Okay, good afternoon, everyone, and thanks to the fellow panelists for joining. As you heard, the topic for this one is challenges to scaling digital assets in the regulated market. Before we get into that, maybe we just do a few introductions, and we'll start at Ami and maybe work back this way.
Hi, everyone. I'm Ami. I'm the founder and CEO of Onera. What we do is we create a layer that basically tries to interconnect everybody here in the room. There's a lot of people here that compete with each other. There's basically dozens of sources of digital securities and digital assets, and there are also dozens of destinations, and practically all of them work in silos. So what we do is we create basically a layer that allows everybody to trade with everybody to allow this industry to grow and become, more scalable.
I'm Michelle Neufeld, Deputy Chief Compliance Officer and Head of Financial Crimes for BitGo. Thank you very much for having me on the panel today. A couple of things about BitGo. Number one, and about this conference the last couple of days, we need more diversity. I'm pleased to see a few women on the panel today, over the course of today. One of the benefits, I guess, is there's no line at the loo, so that's fabulous. But diversity will bring us diversity of viewpoints, so that's a personal plug of mine. You've heard a lot. Who thought compliance could get a round of applause, right? Who applauds compliance? I'm happy to be here, though. You heard a bit about BitGo this morning with Nick during the fireside chat. The only other thing I'll add is, we've just announced our 24/7 vault operations. So you heard earlier today, 24-hour SLAs. We're in about the 4 to 6 hour SLA to get out of cold storage. So I'll end with that.
So, afternoon everyone. Andrew Peel, Head of Digital Assets, Morgan Stanley. Cover the topic of crypto for the clients, institutional clients mainly, and also the space in terms of use of technology more broadly at the organisation, and glad to be here.
Good afternoon everyone. I'm Matthew McDermott and I head the digital asset team at Goldman Sachs. There's a broad array of things that we do within the team, but obviously today's topic of discussion is very relevant.
Yeah, thanks, everyone. So as you can see across the panel, we've got some pretty well-established participants in this market, and we've got some challenges from Morgan Stanley and Goldman. So as we kind of as we get into sort of the broader discussion, I think you think about the topic heading, it's challenges to strategic to scaling digital assets. That sounds negative. It isn't. I think one of the things that there's a lot of optimism, there's a lot of appetite for this particular topic, but I think when it comes to actually getting things done, being healthily cynical, and I mean healthily cynical, not negative, is actually quite important, and recognizing some of the constraints so we can work through those constraints and actually execute. So that's some of the stuff we're going to talk about today. Equally, we've got a market to create, and it's a bit of an anathema to some of the participants in this space to have to collaborate, but we have to collaborate to create a market, and then we can compete. And that's where you get better service, better innovation, better products for clients, et cetera, et cetera. But that's, I think, where we're sort of at in this space, and talking about scaling and how we get that collaboration to set the conditions to compete is going to be quite important. And then, regulation is quite a key one, but this isn't going to be just about regulation. It's also regulation, when it's a regulated market, it's not just about regulation. And it's also not just about markets that are regulated today, but it's about convergence between existing regulated markets and regulation that's coming on other aspects of the market, and how those will converge over time and fit together to create what we hope to see is a broadly liquid, much more advanced, much more sort of developed market in this space as digital assets evolve over time. So as we kind of keep those sort of thoughts in our head, we're going to pick on a few themes. And the first one we're going to go after is liquidity. And Matthew, to you really, we're seeing a large number of product launches, but a whole bunch of R&D efforts. There's been some really successful experiments out there that people can talk about sort of I guess afterwards. But what are the key challenges turning that specific, like Project A, Project B, Project C, into scalable trading activity, things like cash, interoperability, et cetera?
Yeah, thanks, Scott. Excuse me. And I think a lot of these topics that I'll touch on have been covered over the last kind of day and a half. And there's nothing here that I don't think people will be familiar with. But as we build out, a key part of our client business, which is looking at tokenization, looking at digitally native issuances, talking to a lot of people who would invest, one of the key things that they're focused on is that ability to kind of see liquidity on chain. And so that kind of presents kind of a number of different kind of challenges. The first one I would say is digital currency, to have it kind of ubiquitous across many different platforms. And so as we think about thinking about even just the primary issuance, corporate actions, secondary trading, even introducing derivatives on chain, the key thing is cash. And so one of the things that we're very focused on this year is really kind of trying to deliver not only kind of on the projects that we've been mandated on, which are pretty broad, but also really kind of taking that next step. And then when you start to think about digital cash, what is it? Which one is the most relevant one? Is it a stable coin? Is it a tokenized deposit? Is it a CBDC? So there are just a number of kind of interesting kind of discussions there that we continue to have, both internally, but more importantly, to Scott's point, across the market to see where we can actually get the greatest form of adoption. So I think, liquidity is one. Some of the other challenges, again, not new, but regulatory. I think the previous kind of, panelists talked about kind of having a global uniform regulation. I think, that would be utopia. It's just not going to happen. And we're starting to see now, obviously, the executive order, starting to a little bit more clarity in the US, but still some way off. You've got MICA in Europe, which was touched on yesterday. I'm a little bit more positive on it, to be honest, because I think it does give us a framework within which we can actually start to really kind of explore some of the things we're keen to do, which we just can't do, in the existing kind of regulatory environment. And a good example there is the transaction we did with the EIB last year, the ability to actually remove the custodian, the CSD, and actually have the blockchain as the authoritative source of truth. That's quite powerful, and if you can really scale that, you can really just see how this technology can really be kind of powerful on the forward. But kind of pivoting back to liquidity, that again is key in terms of adoption for the points that I mentioned. And so from a regulatory perspective, for us, just having that ability to market make, say, on a public permission blockchain. Sounds simple, but because we are not able to hold crypto presently under the regulatory framework, it means that we can't pay gas fees, whatever, to actually kind of facilitate transactions. So there are things that you can do to navigate around that, but you want to make this kind of seamless. And so that's, another key area for us. I think interoperability, again, across different platforms, I think it would be kind of slightly disingenuous if suddenly you had this fragmented DLT kind of approach whereby you've got people working on all these different platforms and none of them are interoperable. As a function of that, we've been very focused on layer 2 because we think that's probably a very neat way for us to be able to experiment on different underlying layer 1s, but at the same time have something that is potentially useful for everybody. And then finally, and this is probably the least sexy, integration with the internal systems. That's key in terms of success. And one of the things that we did with the transaction we were involved in last year was actually have the transaction from the blockchain feed down to our books and records. So that was very powerful, that was systematic, and so that just gives us confidence now as we start to build out on these projects.
Thanks, man. I want to pick up on the cash point, because that has been there's been a lot of focus on the digital assets and securities, the sort of particularly tokenized versions of those, et cetera, but there's not a lot of cash in the market. There's a lot of chat about CDBCs, stablecoins, et cetera. Where do we think that's going to go? Like, there was a conversation this morning about CDBCs. I feel that is a very long run to get to something that actually is policy compliant and governments are really comfortable with. But do we need to go that far? Can't we do something short of that? Can't we get something out there quickly that actually unlocks the potential of securities on chain, like Amy or Michelle?
So I think the easiest thing that we saw done is basically to just digitize, basically take a digital copy of an asset, of cash in an escrow account. And you create a digital copy of it and you connect them to each other, and when that moves, the other one moves, and effectively you have a digital version of money. And that's something that can be easily done if you have the right regulation, and that can be used. But the important thing is that if you have that digital cash on a specific ledger, to the point of interoperability, you need to be able to trade it against assets that may sit on a different ledger, right? So that's another problem. So that's the easiest thing to do. The second thing that can be arriving into the market, which I think is very interesting, is looking, for example, at treasury tokens as a way of payment, as a settlement mechanism. Because treasury tokens are securities already, they can bear yield and they can be traded. So that's the next one. And then you have, stable coins. Stable coins are suitable for some use cases. And I can give you an example. I'm due to get some payments from one of the tokens that I invested in, and they gave me two options. You can give us your IBAN, and we'll send it to you in a few days, and we'll take a hefty percentage, or give us your USDC address, and we'll just send it to you. Yeah. And for me, as a user, it's good enough, and for many use cases, it's good enough. Maybe it's not the solution for the repo market or other markets, but for some market, it is there. But I'm not going to hold my breath for CBDCs. That's going to take a while.
Yeah, I think that's right. I mean, the one thing I would make, the point I would make also with stable coins is the liquidity drain. I mean, there's this talk constantly about kind of this financial intermediaries being kind of, I guess, disintermediated, if you will. And even, it's very important because if you have cash held on a bank's balance sheet that you tokenize, there's obviously risk associated with that. And also you're actually allocating 100% of cash to actually support the kind of stable coins. So there is a drain that's so it's less efficient than the existing system. You benefit naturally from DVP and all the frictionless stuff that you can do on chain. So I do think it's something that will evolve. And I do think that wholesale CBDCs, we're 2-3 years out, I think will be quite powerful.
Okay, thanks. So maybe we'll pick up on the second theme. We've alluded to a little bit about interoperability. And maybe, Amy, for you, on the topic of sort of interoperable ledgers, creating cross-chain trading opportunities, where do you see this going? And how do you see the appetite across different institutions for that particular activity?
So, we are in the business of providing interoperability, and what we found was that the demand for our platform was lower when people had just one platform to deploy, right? But when they get the second platform, it becomes a problem, and suddenly they need interoperability, and then they have the third platform, and they need it even more. But then they start thinking about where the assets are going to come from. If all the assets are going to come from your own bank, then maybe you can deploy a platform and just hard code some connectivity. But if you want to take assets from another bank or another asset source, and there are going to be dozens and potentially hundreds of sources out there, you can't force everybody to build a platform that is connectable to you. So my view, at least, is the solution is actually not interoperability, because interoperability is an impossible solution. It's an n-square problem. You have n problem, you have n-square connectivity to be made. So the answer is something like a Swift, like a Visa rail, a rail on top that everybody can connect to. And the solution is not interoperability, but it is intertradability. The ability for a client to have an account with a single identity and have assets on multiple tokenization platform, chains, settlement currencies, and so on, see them all as one in one platform and be able to trade them against each other, sell from one user from one bank to another, from one exchange to another, borrow money against it at a click of a button, GDF style. So all of these advantages are immediately there through solving it through intertradability rather than trying to go the engineering way and connecting layer one to the other, as people have tried to do for the last 2 years and failed, and also it's a security risk, all the bridges and so on.
When we think about asset mobility across that space, and maybe Michelle, if you're in the space of looking after some of those assets, how do you think about that challenge?
Yeah, and I was just going to respond to that, right? The idea of scalability of that for somebody like a custodian who has to understand the necessary components of whatever that token or asset is and run it through our processes of doing due diligence on that, and whether or not we're able of taking that on is a feat that is, has to be wrestled with, but it absolutely is a huge challenge for us in this space right now.
So is turning a mic on by the looks of it. There we go. So just to explore a little bit further, when we heard in the last one, there was sort of another layer that would work with Onera, et cetera. The idea of layers upon layers start to sort of worry me a bit, because we then start to look at, we've got now venues, trading systems, risk management systems. One of the things that's appealing about the opportunity to press the reset button on some of the existing regulated market spaces, actually, if I get to the point where I'm using a distributed ledger technology, I don't need all of the other things. I need some of them, but I need all of the other layers. So, when you look at the evolution of the market, you've got the layer ones, you've got different platforms. I want to bring another layer in, then I bring a layer to connect the layers, then I bring a layer to connect those layers to connect the layers. You get this pyramid. Where do you see that natural endpoint?
So I only see two layers.
Yeah,
one layer is a technology layer, the ledger layer. And you can have multiple ledger for different capabilities. So for example, we've just signed a collaboration agreement with R3, so we can, through our network, connect multiple platforms that are running on R3 to each other and connect them to any other network as well. And that's ledger connectivity. But the layer above that is the asset complexity. And the asset complexity, it's not like crypto. In crypto, everything is ERC20, thank you very much, very easy. In every time you go around securities or any other regulated product, there are details. Tokenizing real estate is different from tokenizing bonds, which is different from tokenizing this and the other. So every platform is different. So what you need is you need to have the ability for a client to see all of these assets in one place, and not even knowing about the complexities underneath. And that's a second layer of connectivity, and that's where we are working. So some companies are working on connecting the actual ledgers to each other, which is great. So somebody can build with one piece of code access to multiple ledger, great. But what we're building is we're going a layer above and connecting everybody. And I liken it to the Visa rails and to the Swift and Fix rails. So one layer that everybody can trade with everybody. And I think you mentioned it before, Scott, in one of our conversations, that there's not going to be one. There's going to be a couple, but not 5. So if there's going to be 2 or 3, then we'll connect with the others. And like MasterCard connects with Visa, and it's and that's the way the whole thing works. So it's not a pyramid. It's just 2 layers of connectivity, and both are needed.
I agree. Yeah, I mean, I don't have too much more to add. I mean, I'd agree with that, and I think that also the layer 2 does give you the ability to do greater scale, and if you think about privacy and things like that, it can be more helpful potentially.
Yes, and also to your point before, you talked about custody. When we did a protocol like that, and we had a POC where 3 custody providers connected to the same platform. They don't like each other very much, but they were all in the same room, actually connecting, knowing that it's in the benefit of everybody to cooperate.
100%.
Yeah, but I think we have to get to a common denominator or a few common denominators. And I think with the pace of innovation and the pace that the crypto native industry is at, getting consensus on what those 3, 4, 5, 10, whatever the number of the denominators are, is going to be incredibly challenging. It's not all ERC20. I wish it were. It would make my digital asset vetting call very easy every week, but it's not. And even if it is ERC20, it's still a ton of uniqueness within those assets.
I oversimplified it, but digital securities is 1,000 times more complicated.
Yeah. True.
Okay, thanks. So I think maybe moving on to sort of everyone's favorite topic of regulation. So Michelle, I mean, you've been looking at sort of the space here for a while, and as we think about the potential for existing markets and new markets to connect over time, that convergence of regulated markets and regulation coming to currently unregulated markets, how are you seeing that landscape change, and what do you think the key challenges for institutional market participants to trade new types of assets might be?
Yeah. So this topic I think has been discussed. Great conversation over the last day and a half. I'm going to try to tease out a few different aspects of those conversations to just add a little bit more to the conversation. So I think language is an issue. 25 years on Wall Street, a year in a crypto native company. We are not talking the same language. Wallets aren't accounts. Sub-accounts aren't receive addresses. And in terms of time, right? We're not, in my company, looking at 1, 3, 5-year planning. We're looking at 3 months, 6 months, 9 months planning, right? And if you can't get it done in 3 months, 6 months, you're on to the next thing. So I think we're not talking the same language, and we need to start to have some cross-pollinization of the language. And then I think we'll see greater confluence as we move forward. I think attitude, right? This idea of death by a million RFPs that we heard yesterday and we heard a little bit this morning absolutely is. We're happy to participate in the RFP process, but 12 months to get through the RFP and then another 12 months for a proof of concept. Again, I'm 3 months, 6 months, 9 months. And I think also with attitude, appreciate the executive order, appreciate what's going on with Mika and others around the globe, but if you look at some of the language in the executive order, same business, same risk, same rules. Kind of, but not really, right? And that's an attitude. Some would call it enforcement by regulators. I just call it enforcement. And so while we're seeing and hearing some of the right things in the executive order, we're also seeing and hearing in press releases and public statements something that doesn't exactly feel the same as it does in, for example, the executive order. And then lastly, I thought the last panel was going to steal my next idea, were tax implications, right? How are we treating these underlying securities? Maybe we understand that, but if we're staking other assets or other cryptographic assets, are those property, not property? I'd urge everybody, if you haven't heard about the Jarrett case, I think it's in Tennessee, take a look at the Jarrett case. I mean, I think tax implications here in the United States is another big area where scaling and our response to regulatory requirements is going to be a challenge.
Thanks. And Andrew, I mean, you sit in a heavily regulated bank in a forward-leaning regulated jurisdiction in Switzerland and looking at crypto. Like, what's your perspective on this?
Yeah, look, crypto has always been super interesting to me because it's this intersection between finance and this world of innovative technology. And we're sat here in Silicon Valley with a mantra where you move fast and break things, and you just can't do that in traditional finance. There's the mantra, don't ask for permission, ask for forgiveness. Well, you just can't do that with, massively regulated institution like Morgan Stanley, Goldman, or JP Morgan. There's too much to lose from the existing business lines to do something drastically quickly without the proper approvals, because the whole crypto market itself is still sat around $2 trillion, and just to put that into perspective, the stock of Apple alone is 2.8 trillion, and obviously we trade way more than just Apple, Google, Facebook, and all of the other major companies, the largest global companies around here. So yeah, it takes time. It can be massively frustrating, but at the same time, we think it through, and we have to do things in the right order that these major institutions and major regulators will encourage us to develop a structured marketplace.
And what about the idea, everyone's still looking for clarity of regulation. We have a lot of regulation now, and although we might not always like the sum of those regulations as they sort of put a constraint on some of the business we want to do, each and every one of them is there probably for a pretty good reason based on previous market experience or previous market conditions. You can do a lot in the existing market. You may not be able to do a lot with crypto. When we look back at regulated markets and securities and regulated markets, I personally take the view that actually if you can operate above the existing regulatory threshold, it's just a different technology. You can get a lot of stuff happening now that enables longer term development as these things converge, and clarity comes with the newer assets and the newer types of assets we will see and types of technology and the regulation associated with that. Is that an approach that you see as consistent and you hear that back from regulators, or is that something that's a complete anathema? It does feel like you can operate in a pretty free, clarity in the United States, because I haven't written anything down, is arguably better than clarity in Europe when they've written some rules that no one's tested, no one's seen anyone in court, and no one's really sure how much risk they want to put on the table because they don't know what the rules are going to be when you really test them.
And I think we've seen that with regulatory sandboxes, right?
Exactly.
And this is not the first place we've seen the concept of regulatory sandboxes. You look at the financial crimes compliance space, and there were some real innovative regulators a few years ago, right? Your financial crimes compliance units are probably the largest users of data in your financial institutions. And how do they crunch and manipulate and understand all that data? They use AI, they use robotic process automation, and that was all a result of regulatory sandboxes, allowing firms, companies, financial institutions to quickly learn what worked and what didn't work, and with some grace from the regulators about what the output of those sandboxes are. So I think that's hugely important.
Yeah.
I was going to say, we took a slightly different approach. We went to start with a private securities market. In the private securities market, the rules are clear, and in many cases, what you practically do is you replace an Excel sheet. The cap table of a company is an Excel sheet, right? And nobody can claim that an Excel sheet is better than a ledger that shows everybody what's in the Excel sheet. I mean, it's clearly not as good. So there's no problem there. And in that market, we don't see as much use of the sandboxes. Like a company like Archex in the UK just went ahead and got a license, and they can start trading digital securities. In the US now, DTCC has come out with a plan to launch DSM, and we're connecting with it as well. And the whole idea is that you can go in and you can do these things because they are just using existing regulations. Now, those regulations in some cases don't make sense. They were built in the 40s, and they put all sorts of unneeded restrictions, but you know what the restrictions are. So you can program them into the platform, and you can go to market, and you can get stuff done. And I think what I'm actually seeing is that a lot of the providers of technologies for crypto that want to get into banks are more likely to get into bank through digital securities first than crypto. Crypto will appear after digital securities, and we're seeing that a lot.
Yeah, no, look, I think from my perspective, I agree with that. But I think as we try and be more ambitious, we do come up against, the regulatory kind of limits. And so the sandbox is allowing us to explore, and I think will actually be very valuable for both parties. The other point I'd make is in the many different things that we've been working on, the actual collaboration between the regulators and the bank has been very different to kind of previous markets that I've been involved in, which I found hugely valuable because it's symbiotic, because there's a lot of this technology that's just moving so quickly. Everyone's trying to thoroughly understand it, and actually working collaboratively does mean that you can learn together and actually get the right outcome. Also, I think it's important not to do something just for the sake of doing it. For me, it's doing something that's scalable, rather than just a quick win that then you're going to have to kind of reconfigure at some point in 6 to 9 months' time. And so we're very much thinking on the kind of 12, 24, 36 months as we think strategically forward.
But I think your point on public sector, private sector dialogue is hugely important and shouldn't be, undersold. I think, again, I'll call on my financial crimes compliance experience. FATF, a standard setter for regulators around the world, setting standards for financial crimes compliance, really engaged the private sector in ways they hadn't before to help educate them on how the global markets worked. And we saw absolute improvement in the regulatory schemes that they suggested to the world regulators to put in place. And so we were able to see exponential movement forward because we had a common foe, right? Nobody wants to have bad guys using their financial institutions to do their illicit acts. And I think that same spirit, that same openness to hearing private sector, real world concerns, and if they come at it from an open mind, they can really learn where those friction points are. I'm going to take travel rule, for instance, right? Maz has said they won't issue licenses until there's a travel rule in place for the digital asset space. And, the digital asset community went back and said, blockchain, do you really need the travel rule? And there might have been a missed opportunity there, for example.
Okay, thank you. And I think, as we move on from sort of regulation and we look at that, existing regulated markets. And going back to the topic, this is like scaling regulated markets. How do we get there? We get through the sandbox, we do some stuff in existing above regulation that sort of builds a sort of broader argument. But there is the longer term aspiration for the genesis of this whole debate being the crypto economy to then sort of converge with that and actually have financial markets where you have the freedom to sort of trade a number of these assets together in a way that work for investors and work for issuers as well. Andrew, when you sit in that space, do you look at your current set of clients? And demand is a key thing here, right? Like, why are we going to do this? We're going to do it because client demand, not just because it's great fun, right? Like it becomes a pretty short-lived self-licking lollipop if we just do it for the joy. So you have your current set of clients. You have appetite for digital assets, and what's the noise you're hearing? They're looking for pure, new asset exposure like crypto. Are they looking for different versions of the same product? Are they looking for a combination of these things? Like, what are you hearing from your clients?
Yeah, I mean, it's highly correlated with price action in terms of clients coming in for conversations around, initial exploratory, what's this topic of Bitcoin initially back in, I think first started speaking to clients in 2016 around crypto. Although I mentioned, the scale of the market still being relatively small in the grand scale of things, like the sheer multiples in terms of the returns just attract people's interest and thinking, well, there must be something there that's of value to look into. But the conversations have definitely evolved from these early exploratory conversations to be far more sophisticated. It's not just Bitcoin per se, it's the whole, I won't even call it asset class, because really if you look at the entire crypto market cap, there's multiple different types of assets within that sector. And even if you just look at the top two, so Bitcoin, ETH, and Ethereum, it's not just ETH, the asset, the number 2 market cap, it's also Ethereum, the network. And you start to see clients, sophisticated investors, thinking about the economics behind the use of Ethereum, the asset, on top of the network, Ethereum. And to Matt's point earlier and highlighting the EIB bond deal, this is like a classic example where the network itself that the asset exists upon was used then for like regulated issuance of bonds. So it can go quite deep, and that's even just scratching the surface of the top 2 crypto assets. So you start thinking about the economics of ETH, you start thinking about like the staking yield. Do banks, do traditional financial institutions, do other market players start to offer services like staking and maintaining of these networks, which then aligns with potentially new security issuance and use of these networks for regulated activities?
And some of the practices we see, like easier borrowing and lending, and different types of practices we see in the crypto space, we see appetite and people talking about bringing those straight into regulated markets, like where there are very well-established rules, as we know, about sort of being able to do that. But actually efficiency and speed would bring real liquidity to some of those markets. Are you hearing much around that? Matt, are you seeing any of that?
Well, I think I'd kind of go back and pick up on a point that Andrew made, which is slightly different to your question. But in terms of what are clients talking about, so...
Yeah, but answer the question.
So clients are obviously talking, I'll come back to in a second. Clients are obviously kind of very interested in the crypto market, but are also very mindful of the limitations for banks. So there's only kind of a certain amount that we can do. And so on the back of EIB and other things that we've done, the intraday transaction with yourself, actually across the whole institutional divide, sovereigns, asset managers, etc., there is this huge appetite to learn about, the layer ones, and it's not just Ethereum, it's the others. They want to know actually where can this be more powerful? How can this transform our business? And then looking at how they can apply it. And so we've actually spent a huge amount of time really thinking through, kind of tokenization of real assets, as I mentioned earlier, digitally native debt issuances, and what makes that more scalable. So that's where clients are really focused. And, we've got a huge amount that we could do, but it's just making sure that you can do that scalably. So crypto is kind of enabled and kind of created the discussion, but really is so much more now. And then when you start to think of the power of kind of tokenization, fractionalization, programmability, everything you've heard discussed, then the power really can be unleashed. And I think that's where we're very excited about what the future can really hold.
And the answer to the question?
Can't remember what the question was.
Okay, so no, that's fine. So I think again, one of the topics that's come up a bit over the last couple of days is around sort of DeFi, and like the fact that we've heard a couple of times today that news to me, but it's in the rear vision mirror. But I think I'm not necessarily a full buyer of that. I think actually less centralized. So you heard it here first. LeFi is the next term, less centralized finance. So that's a probably more realistic expectation for us, because there's actually a human expectation when there is a crisis, and the crypto market will go through it, regular markets will go through it. People like to look at a central party and say, what's my position? Where I think there's an opportunity is in distribution of some monopolies around those central parties. Are you guys sort of starting to feel a bit of momentum towards that? Is it like I don't see a complete disintermediation. You spoke about like getting rid of custody. I'm not sure that's the right answer. Like, where do we see that going?
I think that at least what we're seeing is a lot of ideas that were born in crypto that are now being taken and implemented in the old financial markets. And I'll take your question about DeFi as a good example. In DeFi, we learned that you can actually borrow money against something without a credit check, and just go and borrow it. And if it goes below a price, you lose it, and thank you. So, and that's how it's done. It's super, super simple, and it works. So now we can take the same thing to tokenize activity, and somebody on our network can take any asset, and any other organization across the network can basically offer a pair. They can say, I'm willing to lend you so much money against so many securities of that type. And then you can click a button and you can borrow money. So now you have these assets, and especially when you're talking about private securities like buildings and shares, you could be sitting on tens of millions of dollars and have zero liquidity. And if you need liquidity for a short-term period to leverage a deal, to short something, you cannot do anything. And with this new technology, you can just go in and you basically collateralize your asset. It's being pledged to the lender. You lend the money, you return the money, it's unpledged, and everything is done without a credit check and quite instantly. That's something that is learned from DeFi, but it's done in a proper way in the financial, and we're going to see much more of this. The whole idea of wallets is basically born out of crypto. Yeah. But we can use that, the idea of wallets. And I believe actually that all accounts will end up being digital. All accounts will be digital wallets. All accounts will have an address that the ledger can assign value to, and all accounts will be able to sign with a signature that proves the intent of the user, either the user signs or the custodian sign, but a signature that proves mathematically what the intent was. And if you do that, these two things, you have a way of everybody connecting to everybody, and everything in the middle can go away. All the intermediary platforms and margins and errors, and you can have new. So the short answer of what I'm trying to say is that the ideas are coming from crypto, from the wild west of crypto, and everything there is going up and down. But those technologies are now being implemented to really transform the digital market of financial markets.
Yeah, I mean, I completely agree with that. And I actually kind of think this is a bit of an oxymoron, but a regulated DeFi platform is something that will emerge, you know, I think sooner than perhaps we think. And I think you've got to think around KYC identity. But once you actually crack that nut, then I think you can get to a place where, hopefully from a regulatory perspective, that just gives you a lot more kind of leeway to really utilize and extract the value of the technology. So, yeah, and the disintermediation point, I mean, I agree and don't agree, because I do think this technology is designed by default to improve the efficiencies, remove the frictions. And so where you've got some kind of processes that really do kind of make the whole existing kind of process cumbersome, and you can remove that, I think there is appetite to do that.
I think the risk manager in me is scared by some of those ideas. The idea that you lend money without a credit check, and if you lose it, you lose it. I think that, like, well, we have to understand how the regulators think. We have to understand where that could be a viable solution, right? If you have the CFPB in here, you know, I shudder at that reaction.
If you lose it, you lose it is what happens in crypto. So in crypto, you borrow, and if you lose it, you lose it. Actually, when we're moving the same logic to the financial institution, you actually borrow against, let's say, real estate. So the bank has the real estate as collateral. So the worst case scenario is they collect. Now, before digital, they couldn't locate, they couldn't transfer, they couldn't take it away from you. Right now, they can pledge it, right? And on our platform, you can pledge it immediately. The bank holds an NFT, which is the beneficiary of the loan. And if there's a mutually agreed default scenario, then the bank gets the real estate, and you don't get the money. So it's, as I said, it's exactly what I said, taking a market that doesn't care about these things, but just engineers doing their best and their worst, and taking it into a world where we can use this same technology to do good.
No, I agree with that. I think, you know, when you come back to the sort of question of, like, what are some of the challenges of sort of scalability in regulated markets, it is about sort of having the ability to let capitalism run its course. And we think about some of the processes in the crypto markets, they are more efficient, they are a better process. You can get to the investment hurdle, and they'll sort of find their feet, and they will land in the sort of broader markets, and you will have that sort of improved process in the regulated markets, scalability in the regular markets, convergence with, you know, it was a broader set of financial instruments. And it does mean it's also not binary. I think a lot of conversations people talk about, it's like, oh, it's got to be that way because it's crypto, or it's got to be that way because it's regular. Like, if you really think about the broader sort of liquidity of the marketplace, like, it doesn't really matter. It's not either or. It's both. There's convergence, and then there's good opportunities for multiple different types of players, like today, to play multiple different types of roles. And I think if we can start to crack some of those things, and I go back to the point we made at the beginning around, if we can collaborate to create that marketplace, then you enable some of those things, create that scalability, and then we can compete, and we can find our space in the right market for different institutions. We've got a couple of seconds left. If there's any parting thoughts from the panel, or we can open to questions. I challenge someone to ask a question. Go on. Let's break them all. There we go. Look at that. We've got a taker.
Yeah, thanks. I didn't really have a question. I just wanted to see the furthest person from the mic, get the mic. Robert Young, Texture. I wanted to ask Ami to get us some color on a couple comments that you made, if you would. One, you said that digital securities were like 1,000 times more complex, something like that. I'm paraphrasing a bit. You also said that, and this is definitely paraphrasing, that adoption of digital securities would pave the way into banks for crypto. So I think you give us a little color on those two kind of overlapping statements, so it'd be appreciated.
So I think that at least where we're starting with private securities, the rules are complicated, but they're known. So we can automate them. There are many tokenization platforms here that token it, actually, program the complexity. And what we do as an interoperability layer or intertradability layer, allow everybody to trade with everybody. So this is, our role in this market. And what I can tell you is that we've seen multiple cases where, you know, we're working, for example, with a custody provider who is selling mostly, you know, crypto, but they're getting into banks through us first because the bank will adopt digital securities before the bank will adopt crypto. And the same thing for custody. So if you're trying to knock on the door of banks and waiting for the banks to let you in just with crypto, you might be waiting a while because the banks are waiting for regulatory clarity. But the banks are going into digital securities and tokenization earlier, and they need the same kind of services. And that's what I meant. So working with the industry of tokenization and digital securities can help the kind of those industries around it, specifically custody.
Yeah, I was going to, depending on what you said, I was going to chime in there. I mean, I think you'd actually probably see that both in parallel, with the regulatory backdrop probably more favorable to allow kind of, you know, banks like ours to actually participate in the crypto market. As it is, you know, on the trading side, for example, we do, you know, as much as we possibly can. You know, we've done some stuff just recently that's been in the press. But because we can progress, you know, quite quickly on the tokenization or the digitally native issuances, whatever it is, tokenization of derivatives, even the stuff in the commod space, naturally, you know, we see huge benefit for our clients, you know, and the market more broadly. So we're accelerating our focus there, but obviously kind of trying to also at the same time do what we can on the crypto side. So I don't think it's an either or. I think it's just a function of where, you know, the regulations are.
Okay, thank you. I think we're out of time. So Amy, Michelle, Andrew, Matt, thanks very much.
Thank you.
Thank you.